Bitcoin new high looked weak and could fail. And we point right out the numbers. If it breaks 61,700, look out a little bit. Break 60,000, look out a lot. And here we are this morning. I wake up and it's just under 48,000. Now, why am I looking at Bitcoin here? I'm not in Bitcoin. Some of you may be, and I do look at Bitcoin because a lot of people are interested for good reason. But the reason I look at it, it's been one of the best leading indicators for the stock market. And back at the 2000 tech peak, the internet stocks, that index, which was like the blockchain and Bitcoin today, peaked a couple of weeks before the S&P 500 did in that big crash. And back in late 2017, early 2018, when the last major bubble peaked in stocks before we got into this megaphone pattern, which of course I've touted many times and is very ominous ahead, maybe a 45 to 50% crash in the next few months. Bitcoin peaked several weeks before stocks then. So this is turning out to be my best leading indicator in a time where things are so convoluted from so much government manipulation. And now, the stimulus, I keep tallying up, counting the new infrastructure plan, all the fiscal and all the monetary stimulus since COVID or just before, like 55% of GDP. This is beyond absurd, but that's what it's taking to keep this bubble going. It's also a sign of desperation and that we could be in the final days here. So I do think this is an important time to be looking in the markets. Now, also, of course, we just heard, and the markets are shaking this off. I don't think it will be for long, but Biden's coming out and, of course, raising taxes. And, of course, he's starting out with the rich, okay? But it's going to have to trickle down with these huge deficits we're having, and we've seen nothing yet with the downturn coming. He's going to raise the capital gains tax back up to, 39.6% plus, some other financial asset tax, on the people over $1 million. Well, that's not many people, but it is 1.58% to be precise of the tax returns filed. And that means probably closer to 1% of households, but I always state 1% is not 1%. 1% is 40 to 50% at different times of financial assets and wealth, okay? And they are 20% of spending. So for the stock market to be looking at this beginning of this predictable assault with high deficits and slow economy and Democrats taking over and just say, well, it's no big deal. No, this is a big deal. Now, I'll add a few other things. I want to give a shout out to a few people. We have a few people around the world who over time, we just develop a relationship when they feed us good information. They see something interesting and they're good for it, good at that. And one of them is Naomi St. Martin in Australia, Doug Robinson, a financial advisor, his own firm, Robinson Capital Management, Randy Kuntz with Raymond James, and here in Puerto Rico, Miguel Cole of UBS. Miguel just sent me some charts recently, as these people do. And one of them is one I've tracked over times, but I hadn't seen it updated in a while. It's like a logarithmic chart of the S&P 500 all the way back to the Roaring 20s. So it captures the Roaring 20s bubble burst, the 32 lows, the 74 lows, the 82 lows, and this whole bubble since. So I hadn't looked at that chart in a while. And when I looked at the bottom line, the most extreme, which would be like the 74 and 82 or 32 bottom, it was like 1,500 or a little bit higher on the S&P. And of course, some of my targets and patterns suggest we could see as low as 600 to 700 and 5,000 to 6,000 on the Dow. So that was okay. So I'm looking at this. Okay, well, that gives me a different perspective. It could still go lower than that with these extremes and all this stimulus, but it's just good to look at charts and things like this. This is the time to get serious about the markets and your investments. And you may be listening to me and people like Peter Schiff and Jim Rickards, and that's fine. At least all of us agree there's a major financial crisis coming, and it's coming sooner than later, and it is going to be serious, okay? And I don't mind you listening to both, but there is going to come a point in this progression, since I am different from the gold bugs, because I see the treasury bonds being the safe haven, and they see gold being the safe haven. And that's going to become evident pretty early in this crash. And so you need to be paying attention here. The next crash on this megaphone pattern I've been touting, it's the most important single chart that's been developing over the last several years. The next crash, the final break in that, the end of that, and the crash to the bottom of that megaphone pattern, which is a lower low from the two before, says 2,100 on the S&P. It's at close to 4,200 today. That's almost 50% crash. And remember what I just said about that chart Miguel Cole sent to me. It might be with all the, the backdrops and government stimulus, even though they lose control of this bubble, which they will at some point, that we may not see lower lows and say 1,500 on the S&P. What I'm saying is most of this crash, or a big part of it, could happen in the next few months. Looking at Bitcoin more as a leading indicator for stocks and saying, you know what? Yes, just as I said earlier, this new high, but it looks weak. The internals of this rally were not strong. This thing could reverse and gave very precise targets when it gets serious about it. And here we are, from almost 65 down to under 48 this morning, and the next support's at 45 to 46, and if it breaks that, it's 30. So this is important stuff to know, even if you're not into Bitcoin, because Bitcoin has been the best leading indicator. I find things always change, and especially in this environment. And you might say, and most of us might, oh, I'm not a trader and I'm not always adjusting my portfolio. Fine, this is the time anybody should be making major changes to their portfolio. And the difference in the short term of getting out before this next megaphone crash, if that happens 45, 50, and getting out now, or putting in new money, the market's in a correction versus, our short-term stuff is very useful even for long-term investments when you are getting new money or taking out money or making changes. And again, if there's any time you're going to make changes in portfolio, and if you're listening to me or Peter Schiff, you're going to be making them in this time frame, I say it makes sense to take that little extra risk. I understand this. There's no more frustrating market for me and you, that we know this is a bubble. We know this is going to peak, but they just keep throwing more at it, and it will just blow when you least expect it. I think people don't expect it right now with all this extra stimulus and the new infrastructure plan. Oh, they haven't even gotten all the other stimulus out. They're already throwing more stuff in because they're that scared this thing's going to fall apart.